Hello. Today we're gonna talk about the money and the economy, the role of money in the economy. This is also fifth chapter of your textbook, Introduction to Economics 2. And in this lecture or in this video, I will give some brief explanations about chapter 5. Firstly, when we cover the learning outcomes of the chapter 5, in this chapter, we see the functions of money in an economy, the evolution of money in time, and the contents of money supply concept. The third one, how banking system creates money under its basic operating principles, and how Keynesian economists explain the relationship between the quantity of money and economic activities. The other one is how classical economists explain the relationship between the quantity of money and economic activities. And the last one is how central bank uses the tools it has to control amount of money. In here, or in this chapter, actually we try to understand the role of money in the economy. And firstly, we need to understand the role of money in the economy and how this money, which means money supply, is controlled by the central bank, and how central banks controls money supply via banking system. So there are two important actors in this process. The first one is the central bank, and the other one is the banking system. If we understand this operating process for the central bank or for the banking system, we can easily understand the role of money in the economy. Money has three basic functions in an economic structure. It serves as a medium of exchange. So this means that the money is used for exchange process of goods and services in the economy. And also it serves as a unit of account. So unit of account means that the money is used as a common measurement for comparing goods and services in the economy. And also money serves as a store of value. So store of value means that the money is used for keeping purchasing power for the future. Of course, central banks try to control on money supply in the economy, and there are different money stock definitions to follow this process. For example, M1 is the narrow definition of money stock and is equal to currency in circulation and demand deposits. The other one is the M2, is the broad definition of money stock in the economy, is equal to M1 and time deposits. The other one is the M3, is the more broad definition of money stock, and for the M3 we add the repo, money market funds, and debt securities issues for to M2 money supply process. Okay. And central banks try to control money supply via banking system. Banking system, in here we can say that the banking system is a vessel. So we can say that the money is the blood, central bank is the heart, and the banking system is the vessel. So because of that, banking system is important, and because of that, we need to understand the basic operating process for a bank. So basically, when we look at the balance sheet of a bank, there are two parts: assets on the left side, liabilities on the right side. So liabilities means that where the funds comes from, and the asset side or on the left side shows that the usage of these funds. Okay. So this also explain the money creation process. In here we can also this example can be found in your textbook. For example, when there is an increase in demand deposits as 1,000 Turkish lira, there is a this is also starting of the money creation process. So there is a increase in the same value. So the bank use this reserve as required and excess reserves, and also excess reserve is used for giving loans. So these loans, for example, in the economic system, goes to the other bank. So this bank also use these deposits as required reserves and as loans, and this process continue. Okay. So basically, we have basic mathematical equation explains this process. For example, when there is a reserve ratio is 10%, the created money will be 10 times. Okay. Now this is basically say that the 1 is divided 10% is equal to 10. For example, when the reserve ratio is 20%, the created money will be 5 times, because 1 is divided 20% is equal to 5. So, and using this ratio, we can basically calculate the created money. So when there is an increase in 1,000 Turkish lira in reserve in here, so the creating money will be 10 times. So we use the reserve ratio. So we can easily say that the created money in the economy will be 10,000 Turkish lira. Okay. In the first step, there's an increase in demand deposits as 1,000 Turkish lira. End of the process, the created money will be 10,000 Turkish lira in the economy. Okay. So this is important because central banks will control the money supply via this banking system. So in here, this money supply, vertical money supply curve basically shows that this process in the graphs. And downward sloping money demand curve shows that there is a negative relationship between the interest rate and demand for money. So for each market, supply, when there is a supply and demand equal each other, there is a equilibrium level. So in here, the equilibrium level is the interest rates. So easily we can see that the interest rate is determinant in the money markets. Okay, so to determine interest rate or to affect interest rate, the important actor, of course, in here is the central bank, because central bank, for example, increase in money supply. So in the money market, there will be decrease in interest rates. We can see in here. So because of decrease in interest rate, there is a increase in investments. So increase in investments also means that there is an increase in aggregate expenditures and production. So this is called indirect channel. So we can easily see that there is a relationship between the money supply and the production, and this relationship comes from the money market and interest rates. So other channel is the direct channel. So direct channel basically says that using the equation of exchange basically says that the M times V equal P times Y. So in here, M stands for money supply, V stands for velocity of money, P stands for price level, and Y stands for GDP. Okay, so for the short run, we can assume that velocity of money is constant and the production or GDP is constant. So basically, we can say that there is a positive relationship between M and P. So this basic relationship shows that the important explanation for the inflation phenomenon. So when there is an increase in money supply, there is an increase in price level. So more money supply causes inflation in the economy. So when we look at the functions of central bank, there are three important functions of central bank. First one is the ensuring and maintaining stability in money markets. The second one is serving as the banker for banks and as the lender of last resort. And third one is the performing banking transactions of the governments. Okay. So central banks conduct two types of monetary policy. First one is the expansionary monetary policy. The second one is the contractionary monetary policy. In the expansionary monetary policy, central banks controlling money supply effects on interest rates, aggregate expenditures, and production. For example, expansionary monetary policy means that decrease in interest rate, increase in aggregate expenditures, and of course, increase in production. Contractionary monetary policy means that decrease in money supply means that increase in interest rate, decrease in aggregate expenditures, and production. Okay. Of course, central banks has some tools of monetary policy. The first one is the required reserve ratio, is the ratio that is determined by central bank and indicates the quantity of reserves that banking system holds against their liabilities. Discount rate is the interest rate that central bank applies to loans to banking system. And open market operations are central banks purchasing and selling transactions of government securities in the interbank markets. So central banks use open market operations to affect the level of banking system reserves and of course supply of money in the economy.